Okay. Somebody else. Okay. Okay. Well, good morning, everybody, and welcome to the Kushner Report for February of 2025. And at the conclusion of today's presentation, you'll have an opportunity to participate in our question and answer session. So today we have a pretty packful agenda. So we're going to take a look at the key economic indicators, the global economy, domestic economy, mergers and acquisitions, and other significant economic news. And today we're going to take a look at what's ahead in 2025. We're going to address the oil and gas industry outlook, followed by the 2025 housing market outlook. And we have two folks that'll give us some indication of what's taking place in real estate at the conclusion of the presentation. So let's take a look, first of all, at the oil and gas industry overview. So first of all, as 2025 begins, there's still a global uncertainty regarding the trajectory of OPEC cuts and potential disruptions to energy trade flows. And despite the uncertainties, the oil and gas industry, capital discipline, increasing customer centricity, and investments in new technology are really poised to drive robust economy in 2025. So it's going to be a very strong year for the oil and gas industry. When we look at the Permian Basin, and that is the area of western Texas and southeastern New Mexico, they're all rich in petroleum, natural gas, and potassium deposits. And U.S. oil and gas production really contributes in this area 46% of the U.S. crude oil supply and production. So over the past decade, U.S. upstream companies have really prioritized capital discipline, digital transformation, and strategic acquisitions really to grow profitably. And this strategy continued to rise about 7% in spite of the fact that from 2014 to 2023, oil prices have dropped 18%. So in 2025, companies will likely adapt their new strategy to address challenges, including low oil prices, peaking productivity gains, and all-time low inventory of drilled but uncompleted wells. We have almost 4,500 wells that are still sitting out there, and the forecasted resurgence in global liquids consumption that is really expected to increase this year.
Dennis, excuse me, it's Rob. I think we're getting some echo on your audio.
Okay.
Why don't you try muting yourself and then unmuting and see if that helps.
So over the past decade,
I'm not sure about that. Maybe it's just started. Maybe try maybe distancing yourself a little bit from the mic.
Yep, back.
And maybe speak a little bit slower. Let's see if that works.
All right.
Yeah.
All right, so in 2025, companies will likely adapt their strategy to address changes in oil prices, peaking grenades, etc. So what we're seeing now is there'll be a consolidation in assets across the board. So with nearly $136 billion in deals since 2023, the upstream sector really has seen a major M&A consolidation taking place in the Permian Basin. So we see the availability of acquisition targets and refracturing opportunities without significant infrastructure constraints. This makes the basin a very strong rotational area for candidates in both the short and medium term. And then the last 10 years, the oilfield services sector has really lagged behind the rest of the oil industry and gas, as well as in terms of efficiency. And therefore, we're seeing an increase in the shale market in terms of reduced margins and more effective sector operating activity. And the sector's transformation can really be attributed in part to a strategic blend of innovation and cost reduction measures. When we look at some of the oil field services companies are really transitioning to what they call energy technology companies. And that's by diversifying their portfolios to really include low carbon ventures such as carbon capture and hydrogen generation. National oil companies, particularly those in the Middle East and members of OPEC really face challenges in the near term, including one, balancing crude oil supply and demand and maintaining stability, and number two, fulfilling what we call commitments to reducing industries' carbon footprint, and third, helping to really sustain economies if oil prices remain below the physical break-even point in 2025. And of course, OPEC and its partners have really invested heavily into eliminating waste and operating inefficiencies across the board. In many cases, we're seeing organizations are intentionally cutting oil prices to cutting production, if you will, to drive oil prices up. In terms of building new capacity, and some Middle Eastern nations are working to scale technology such as carbon required capture and also storage and hydrogen. And to fund these expansion and diversification areas, these countries are really exploring various financing mechanisms such as public and private partnerships, mergers and acquisitions, and various bonds to secure funds. So diversification into renewable energy such as solar and wind power have really provided economic stability and effectively reduced the physical break-even points burdens that have been in the past of these companies. So the refining and marketing sector is really at a crossroads, and that is with modest long-term growth projections for additional fuels and significant profitability challenges. We're seeing investment renewable fuels are still going to continue to move forward. So 2025 is really projected to be a year of strong growth following monetary easing worldwide. And while renewable fuels, on the other hand, are facing oversupply in the United States, driven in part by lower than expected renewable volume obligations at this point. So when you reach out to your customers, refining and marketing companies are really have advanced and enhanced the efficiency of sales from their retail fuel and convenience outlets by really integrating digital technologies. So the integration of AI and the Internet of Things has really enabled the development of small fuel management systems, thereby optimizing inventory, reducing waste, and enhancing supply chain efficiency. On a global basis, in 2024 marked a significant milestone for the global policies, and that is with over 70 countries representing more than half of the world's population have held national elections, and energy policy across the globe has really been the focal point to look at strategies to enhance better climate change in the future. So what about Europe? Well, in Europe, energy prices are increasingly focused on clean energy adoption, with the renewable energy directives aiming to raise the share of renewable energy in terms of total consumption. So 2025 is really considered to be a pace for green energy technology development. Thus, you're going to see rising costs that will face resistance from customers and contribute to increasing uncertainty and regarding future hydrocarbon demand and development. So in terms of some of the emerging economies, we're looking at China's recent monetary policy stimulus, which is based upon petroleum consumption. So with China's liquid fuel consumption is really projected to grow substantially in 2025. The government stressed that the state needs to purchase more oil, natural gas, and strategic metals going forward. However, the country is still committed to renewable energies. Now let's take a look at the oil administration under the new administration with our government. So first of all, the U.S. is ramping up oil and gas drilling in 2025, and several factors will really shape the outlook in terms of economic impact and environmental considerations. So let's take a look at the environmental impact. You have energy prices, and that is increasing domestic production of oil and gas should lower energy costs for the U.S. consumer. However, OPEC decisions or conflicts in major producing regions could offset these effects. We look at job creation, and that is more drilling typically leads to job creation in the oil and gas extraction, logistics, and related industries. When we talk about energy independence, the U.S. could further become more independent and reduce the reliance on foreign oil, increasing national security in the oil industry. And this may also boost the economy by making U.S. less vulnerable to global disruptions. We talk about revenue generation, and that is increased production could also boost government revenue from royalties and taxes for gas and oil from various countries and companies. We have an environmental impact, and that is here's the biggest concern we have. So, carbon emissions, more drilling would increase the U.S. carbon emissions, which would make it more difficult meeting basically a lot of our climate goals going forward. So, when you look at increased drilling, it could lead to environmental degradation, especially in sensitive areas. And then, of course, you have public opinion and regulation. So, if drilling is perceived as accelerating climate change, or harmful areas, if you will, in the environment, public opinion will shift, and there'll be more regulatory pressure to change the draw of what we're trying to do. Then you have the political implications, and that is domestic policies. So increased drilling could be politically advantageous in oil-rich states, such as Texas, for example, or areas depend upon energy sectors for jobs. And then when you look at international politics, if the U.S. increases production, it might lead to geographical shifts, especially if it affects global markets or challenges in other nations and their policies, such as Russia, Saudi Arabia, or China. So, on a global transition basis, more drilling could slow the transition to renewable energies and sources by diverting the focus away from green technologies. And from a technology perspective, advances in drilling technology such as carbon capture and more efficient fracking techniques, if you will, could mitigate some of the environmental concerns facing all these nations. So, in conclusion, the U.S. could benefit economically in the short term from increased oil and gas production, but there are still significant long term environmental issues that we have to face as a country. So, now let's take a look at the housing market. So, first of all, in 2025, the housing market is really shaped by a combination of economic, demographic, and political factors, making it an important time for home buyers, sellers, investors, and developers to understand the key trends that are really influencing this sector. So let's take a look at some of the issues. So first of all, we have interest rates and mortgage. So after significant fluctuations in interest rates in the early 2020s, as we move into 2025, we can expect more stability in mortgage rates, but unlikely they'll remain relatively high, somewhere in that 6 to 6.5% throughout most of the year. And again, that can change as we go further into the year. The impact on home affordability. Well, here, higher mortgage rates will continue to affect home affordability, making it even more difficult for first-time buyers to enter the market. And in 2025, the increased cost of financing will likely limit the purchasing power of many buyers, especially in high-demand markets. When we look at supply and demand imbalance, the housing shortage, particularly in urban and suburban areas, will likely persist in 2025. But builders are expected to continue facing challenges in meeting demand, which will be driven up by higher prices, if you will, in certain markets. When we look at the home builders, will remain focused on creating more affordable homes and housing solutions, especially in regions with growing populations. And then we have the issue of urban versus suburban dynamics. And while the COVID-19 pandemic led to really migration trends away from the dense urban centers to suburban areas, we'll see that change and it should stabilize as we move forward into 2025. When we look at home prices, after rapid price growth early in the 20s, home prices may stabilize or appreciate at a slower pace in 2025. And that depends on the market. So prices in some markets could even see modest declines if there's a downturn in economic conditions or higher rates persist and continue to limit buyer demand. So from a demographics perspective, you have millennial and Gen Z homebuyers. These are the 25 to 40-year-olds and the 18 to 24-year-olds will continue to be the dominant force of driving home activity going forward. These generations are expected to form the largest group of new home buyers as millennials move through their prime home buying targets going forward. And of course, you'll look at first-time home buyers like the Gen Z folks looking to get into the market. The trend of buying larger homes accelerated during the pandemic era as remote workers wanted to have larger homes to have offices and work remotely away. And that space will continue going forward. And now we have what we call the aging baby boom population. And that is baby boomers, particularly those nearing retirement, will continue to have influence on the market And furthermore, we'll look at downsizing, relocating, or even going to retirement areas to opt out of into restricted communities. The rental marketplace, we're seeing the rental market is likely to see continued upward pressure on rents, especially in cities where demand remains relatively high and the housing market is constrained. So increased interest rates could even drive more renters into the market. And a shift away from family housing. So we're looking at affordability challenge really persist for home buyers. Multifamily rental properties will remain an attractive investment for developers and institutional investors. When we look at the technology aspect of it, in 2025, technology in the home area will continue to be even more advanced, with smart devices being the standard in many new home builds. Now, AI-powered real estate platforms, virtual home tours, and augmented reality will become even more prevalent in helping buyers and renters moving ahead. When we look at sustainability in the green housing area, well, eco-friendly housing, sustainability will become a growing factor in the housing market, especially as climate change concerns continue to rise. So in 2025, we expect higher demand for energy efficient homes that will utilize more sustainable materials. And the affordability aspect, well, the governments, particularly at the state and local levels, will continue to explore policies to address the affordable housing crisis. And of course, tax incentive for home buyers, such as first-time home buyer credits or deductions for energy efficient home improvements, could also be introduced into the marketplace to expand and promote home ownership and sustainability. And of course, you have investor activity. So institutional investors and private equity firms will continue to be active in the housing market, particularly in multifamily properties, single rental family homes, and real estate investment trusts. So in the short-term rental market, Airbnb and Vrbo will continue to grow, especially in vacation destination areas, really creating both opportunities and challenges in the housing supply. So in conclusion, the housing market will be influenced by a lot of key factors, including interest rates, demographic shifts, technology advancements, and political and policy changes. So while the affordability remains a critical issue for many home buyers, there will be complexities and there will be opportunities for those people who can navigate the areas will be successful in finding their next homes. So that kind of takes us through the housing market. Now we're going to take a look at the other economic issues. So what I'd like to do now is take a look at key economic indicators. The gross domestic product, inflation, unemployment at both the federal and California level, and then the price per barrel of oil. So the global economy at this point is projected to go out about 2.7% and then drop down to about 2.5% in 2026. US GDP this year is pegged to go on around 2.3 and then drop to 2.2%. And inflation again is still going to be projected to be over 3%, around 3.1, and then dropping down a little bit to 3%. Now this is done without the implications as we speak about tariffs, and we'll see where that goes as we go forward in the rest of the year. The unemployment rate right now is looking to go out the end of the year by 4.1% and then go up next year to 4.2%. And the California unemployment report is looking more at 5.4% this year, then dropping down to 3.9% next year. The range on the oil is still around $72 to $85 a barrel, and we'll see where that goes as the rest of the year unfolds. So let's take a look at a couple of global things. So some positives here, and that is the Bank of Japan is holding steady. They dropped their rate another 0.25%. On the international outlook, as I mentioned earlier, the real key here is the fact that growth is expected to be 2.7% and more stabilization taking place throughout the global economy. And Mexico, India's bank, and also England, all three banks had rate cuts last month, which is good because they think that inflation is beginning to get under control and they're moving more towards going in the right direction. And the Bank of Australia just dropped their rate again a couple of days ago. So this is good news. All these countries are now looking at reducing rates going forward. Now, taking a look at the U.S. economy, so the Federal Open Market Committee decision this month was to leave the rates unchanged because there's still concerns about inflation. And the U.S. outlook going forward is still very positive for the year. And the fact that we're talking about the fact that we have strong momentum in the economy. So there are solid signs of economic growth. Consumer spending is still very strong, and we have a low unemployment rate as of December of 2024. So, and with strong employment. So, while the advent of tariffs, prices will be lower for the time being, but the purchasing power of the dollar could be affected if tariffs are instituted. So, we're going to see how that goes. And then, of course, we're looking at credit card debt. And again, over the past 10 quarters, the credit card debt has not increased. We're looking now at almost $1.2 trillion in credit card debt, which is astronomical. It's the highest ever recorded. So let's take a look at some other economic indicators. So let's take a look, for example, at inflation. As you know, consumer price index went up a little bit, about 0.5 of a point in January. So we're over the 3% target right now, and there's concerns on that. And that's been still an issue, and the Federal Reserve is still watching it very carefully. The wholesale price index went up slightly again by 0.4 of a point during the month as well. When we look at trade exports were down. They went out about 267 billion last month. That was down about 7 billion from November. The trade deficit increased by 25% in December to $98 billion, and that's not good. That's got to go the other way. Retail sales, the spending saw a major dip in January, and the sales were down by 0.9 of a point, which marks the largest 1-month decline in nearly 2 years. Now let's take a look at the job market. So we had somewhat of a modest gain in the month of January across the country. We saw 143,000 jobs were created, and unemployment did drop down to 4%. But if you look at some of the key areas here, I mean, if you look at business and professional services, we saw a loss of 11,000 jobs. Good news is we saw an increase in construction and also an increase in manufacturing. Those are two critical areas that we need to strengthen going forward. Now, the California report for January is still not out yet, but we do have the report for December. Unemployment rose again to 5.5%. We just had a meager 15,000 jobs created. Construction saw losses. We saw losses in healthcare and education, and of course, manufacturing took a hit as well. And then we had a hit in the area of professional and technical. So not a lot of jobs created, but in the key areas, we saw negative growth. So let's take a quick look at at interest rates in general. As I mentioned earlier, the Federal Reserve, Powell has indicated we're going to put a hold on interest rate cuts going forward. It's not clear how many months we're going to go forward until we see a cut, or do we see an increase? Hard to tell at this point. So we'll have to wait 2 or 3 more months to see what the outcome is going to be on that area. When we look at mortgage rates, as I mentioned earlier, they dropped to 6.6% late February, still around that half time frame. So that rate is still going to hold for the time being, and that most economists believe the year will go out somewhere around 6.5 to 6.25 in the mortgage rate area, and that's the average rate. When we look at the manufacturing PMI was 50.9, which is good news. That's the first time in 26 months we've moved away from contraction. So that's a major impact. That's very positive. The area of factory orders were down about 0.9 of a point last month, which is going in the wrong direction. Small business confidence level is still very positive at 102, and consumer confidence dropped a little bit to 104. Both indexes are considered very good if they're over 100 basis points. Now we take a look at crude oil prices. For example, what we saw here is the good news is this morning it was down to $69.92, and that's down from the $71 that was high in the month of January at the beginning. So the good news is oil is staying relatively flat. The housing market, what we're seeing now is the road ahead is filled with obstacles. We saw in the housing market, basically, housing market starts dropped 8.4% in January across the country, which is a major impact. And the new sales for example, were projected to go out a negative 3.7% in January. However, when we take a look at Southern California housing, Los Angeles, the medium-sized price of those units on the market right now was 886,000. That's a decrease of 2.8% in the selling price. And January sales were down 28% from December, but they were up 0.9 of a point from January of 2024. Orange County continues to be strong. The midpoint there was 1,430,000. That price was up by 5%, but sales were down about 20% from December. And looking at San Diego, the midpoint of the price of houses on the market was 1,030,000. That increased by 5.6%, but sales were down from December almost 18%. As I mentioned earlier, the existing housing market for existing home sales fell by 4.9% last month, and that's one of the highest declines we've seen in many, many months. When we look at construction spending, it was up about 0.5 of a point. It's moving in the right direction, so that's good news. Productivity came out for the fourth quarter, very good, very solid, was up 1.2%. So that's moving in the right direction. The one area of concern, again, that's called company displacement. So a lot of activity took place last night, over the last month, if you will. And aside from the government situation, just companies in general. So Nissan eliminated 2,000 jobs. Dow was down 1,500. Berkshire Hathaway, 4,000. Estee Lauder products in general, 7,000. Salesforce.com, which is in the Bay Area, 1,000. We have a company called Workday, which focuses on technology around AI, 1,750. Meta, which is Facebook, elimination of a lower performing folks, 4,000, and Chevron, 8,000. And then we have Waste Management, 5,000. HUD, which is the Housing and Urban Development, lost 4,800. And then we had the CDC, 1,000. And of course, the U.S. Forest Service was down 3,400. For the first time historically, Southwest Airlines had a layoff of 1,750 people, and there's cancellation of a lot of flights throughout the country. And then the IRS again announced that they've laid off 7,000. And then finally, the Pentagon laid off 5,400, which are probationary workers. So that kind of gives you an idea of what's taking place in industry along with government in the employment cycle. Acquisitions continue to be a very robust market in spite of interest rates. There's a lot of activity taking place, a lot of consolidations going on in different vertical markets. So we have a company called ServiceNow is acquiring Kushner, and basically it's a transformation company that specializes in conversational data analysis and insights. The price was not announced. And we look at Frontier is making another attempt to try to acquire and merge with Spirit Airlines, and we'll see where that goes. And I'll talk about Spirit Airlines later in the report. Allstate is selling their healthcare business to Nationwide for $1.25 billion as they make a shift in their strategy going forward. Then you have a company called Circle is acquiring Northrop's. What they have is it's called Mission Training and Satellite Ground Network Communication Software Business. So that's being sold off $327 million as they move away from that one aspect of their business. Then Mobile Communications America is acquiring Safety.com. This is a company that's a leading provider of wireless communication solutions that enhance workplace safety, security, and efficiency. And then, of course, Hyatt has made an acquisition of a group called Playa Hotels and Resorts. So Playa owns 24 resorts across Mexico, Jamaica, and the Dominican Republic. So they're focusing more on growing their international business. And then we have a group called Solar Winds is acquired by Turncliffe, and basically they're a provider of IT software services. Blackstone is active again. They've agreed to buy AI Fire from Turok, and basically the company maintains fire extinguishers, alarms, and sprinklers and other outdoor products. McKesson is active again. They've just acquired 80% controlling interest in Prisma Vision. This is a provider of author and retina management services. And if we look at private equity firm TPG has again made another major strategic move. They bought a company called Atlas Power for $2.2 billion. And then Wahlberg Berkshire is basically buying Triumph for $3 billion. This is a range of products both in commercial, military aircraft, and also supplying other original manufacturing components for the airline industry. Then Sherwin-Williams is expanding outside the country. They're buying a Brazilian firm for $1.5 billion as they move into the international marketplace. So you see there's a lot of consolidation taking place in the M&A space. Some of this has to do with a lot of companies are not doing well in terms of organic growth. So when you grow, you can either diversify or you can go out and buy other companies to roll up inventory in terms of revenue. So what other significant economics is taking place? Well, this is a major announcement by UPS. They're cutting Amazon's volume by more than 50%, and that'll be completed by the second half of 2026 as the carrier is pushing to deliver more profitable packages. And they want to reduce their reliance on Amazon. So that'll be a major impact to Amazon's business in that particular sector. There's a firm called Realtor.com. They've moved from Silicon Valley. They're moving to Texas. Another company exiting the state of California. The New York Stock Exchange is opening up an exchange in the state of Texas. Texas now has the largest New York Stock Exchange listings, representing $3.7 trillion in value in Texas. So that's going to be interesting. That whole thing will open up, and it's going to be more job creation. Joann's, which has been around for many, many years, is closing most, if not all, of their stores around the country. They're in bankruptcy, and the bankruptcy court has not come out yet with a termination date. It could be in June or July of this year. And then we have TGI Fridays, has been around for a long time. As you know, they're in bankruptcy. They have new corporate leadership, and what they're trying to do is set up some individual franchises, or consider going into hotels. So instead of going into a restaurant, you'll have a restaurant within a hotel will be designated for Fridays. So that's going to be very interesting. And Spirit Airlines on Monday announced they're coming out of bankruptcy. The reorganization plan is working, and there'll be more discussions with a couple of other air carriers about potentially merging with another carrier or two. Then Microsoft had a major breakthrough announcement on Monday. There's a huge quantum computing chip breakthrough they have. And this team created a new quantum chip that claims it'll revolutionize the field by leveraging a new state of matter. Now, again, the chip is not available yet for sale. It's still being worked on. So what is quantum computing? Well, at this core, it's an advanced type of computing that performs computational tasks and solves problems significantly faster than the classical systems. So Microsoft implied that it believes that the conductors can do quantum computing systems just like the semiconductor did for smartphones and computers. So that's kind of interesting. We'll see where that goes. So what I'd like to do now is open it up for Q&A. And what I'd like to do while we have our two folks here, I'd like to introduce Kathy Clark from Orange County. Robert, we can go ahead and turn off our slides.